Warren, thank you for joining us again at Blue Notes.
My pleasure.
Data released today shows that inflation has come in at just under 2%. Was this expected, and how does it change your forecast for 2015?
The numbers were broadly in line with expectations. The headline number was a touch lower, and the core numbers, which strip out volatile items, were a touch higher. In the wash, the annual rates of inflation are now just around 2, a little bit below for headline, a little bit above for core. So they haven't really changed our expectation from the last month or so. The big driver has been the fall in oil prices, which has translated into lower petrol prices here in Australia. There's also been the effect of the repeal of the carbon tax, which is putting a little bit of downward pressure on inflation. We've known about that for some time. So inflation in an underlying sense, though, the trend in inflation is a bit softer than what we thought 3 or 4 months ago. And we're getting confirmation with these numbers that inflation is drifting down in Australia. And when we get the next few readings over the first half of 2015, we think that'll continue. Indeed, the big impact of lower petrol prices is yet to be felt. That'll come through in the Q1 numbers, which will be released in April. So overall, the numbers were broadly in line with expectations. They didn't satisfy the market, which was getting quite bullish on the prospect of a rate cut and looking for a low inflation number to trigger that. So we saw a bit of a strong reaction in markets. But generally speaking, these numbers are in line with Reserve Bank expectations, market expectations, and that is that inflation, therefore the cost of living in Australia, is coming down.
So that fall in the petrol price and the factors you talked about there, does that change your expected rate cut predictions for this year?
It doesn't change the broad story. In fact, it confirms what we were thinking. That is that the lower oil price combined with a generally sort of soft inflation story, both locally and globally, will give the RBA some scope, if they feel they need it, to cut rates and try and get the non-mining economy moving a bit quicker than it has been. And it's a little bit soft, indeed outside of residential construction, property, this sort of thing. The overall non-mining economy is still pretty sluggish. So broadly speaking, these numbers really confirm our view that the Reserve Bank's going to have that flexibility.
From a global perspective, there's been quite a lot of activity recently with QE in Europe and the Greek elections, and as well as the fall in commodity prices. How do you see that filtering through to the Australian economy?
It's going to filter through, there's no doubt. Australia is certainly performing better now and through much of the last half decade than many advanced economies. But we do get affected by the broader economic and financial forces at work. The fact that Europe has now taken the step of undertaking QE could well have a significant implication for Australia, in that it could stop our currency falling, certainly against the euro, but even more generally. Australia is still a strong economy. It's still got decent yield and return, whether that be in terms of interest rates on offer in the market, or the returns that businesses are earning, or the rates of growth in the economy. And with more liquidity in the global system, and even though the Fed has stopped its unconventional policy with the end of QE3 last year, the fact is that the ECB and the BOJ are continuing to pump money into the system. That money could find its way to Australia, put upward pressure on the Aussie dollar, or even just stop it going down when it should go down. And of course that will put pressure on our economy. We can offset that to some extent with lower rates, but not fully. The lower currency is an important part of getting the economy to transition to non-mining growth.
Related to that, Ross Garnaut was today quoted as saying that China is switching to more efficient means of energy production faster than expected. How will that impact the Australian economy if you agree that that is the case?
If it means their consumption around the production side of their economy is shifting towards things like LNG, then that's good for Australia, because our corridor, if you will, into China is in the energy space is through LNG rather than oil or anything else. I think maybe it misses a broader point here. There is a baton change, if you will, in the world economy. The Chinese producer, the industrial complex in China, their energy needs really dominated the world in the past half decade. We're going back to potentially the American consumer, the Western consumer more generally, in the next year or so being the key swing factor for energy. either way you cut it, energy prices are unlikely to go back to where we saw at the beginning of last year, and that will be a headwind for Australia once the LNG starts coming online. So you're hearing stories that we're going to get 30 billion or 20 billion less for our LNG exports in a few years' time, and that's potentially right if the oil price stays where it is now, and that's reflected in LNG prices. But we shouldn't get too worked up about that in the sense that we actually haven't even started that production. So we're not losing something, it's just that there was an expectation that once that LNG starts getting exported, we would have got a higher price.
Thank you for joining us.
Thank you.